As long as the Reserve Bank of India, I mean, if the CRR reduction or increase is announced today itself, from tomorrow the amount of loans that banks can give comes down. So it has an immediate effect in the total money supply.
SLR or CRR both?
No, this takes time. This doesn't contract it. This has a lag effect, time lag. Because the amount of money, let's say you increase 25 to 30. What have you done? Instead of giving loans to general public, you are given to what you call public.
That's why the question I was about to ask you is that even if you have this SLR,
Don't mind, I'm feeling hungry.
does it actually reduce the credit creation?
Short term. Very short term.
No, the thing is ultimately if you look at the link.
Ultimately, sir, you are economic. There's a short term, there's a middle term, there's a long term. In banking, we have a very short term.
So as you said that the loan which are there is to the private sector, this is like a loan to the public sector. Where does it go? Like suppose I buy say nuclear power bond, corporation bond.
It goes into government's account maintained with Reserve Bank, and government has to spend it, then it comes. There is time lag effect.
No, and the thing is the moment you issue a bond, somewhere you have created something.
Sir, if Government of India issues a bond through Reserve Bank, money goes from, okay, let me give you my another favorite case. This is India. Monetary system, money. In this, Reserve Bank is not there. RBI is outside. Because RBI can create money or suck up money. So, whatever goes from year to year increases money supply. Whatever goes from year to year decreases money. This is how accounting is also done. You will be surprised to know actual accounting is done. There is something called a currency transfer voucher. In the end of the day, we know exactly how much is here in olden days up to the paisa. Okay? This is one portion. So, there is one more way, but only Reserve Bank of India putting in money or taking out money controls the total money supply in the system. Okay? In this you have Government of India. Money going from year to year is what you call monetization. Okay?
Yes, it's financing.
Money doesn't go from year to year. Unless it's
a very small amount.
Very small amount, that is repo.
No, the NABARD and all those also.
This is reverse. Oh, that is insignificant.
That's why it's a very small amount.
This is banks. Banks are considered part of this. Okay. This is repo and this is reverse. That is banks giving money to RBI bank. That also sucks up. But this one giving to here or this one giving to here, till it comes out of the Government of India into the Aam Janata, till the government spends its money, either planned, non-planned expenditure, it is kept here, it is isolated. That's the only difference.
So it basically has a...
That's the difference. In fact, it is a very funny effect. Suppose Subha raises from 25 to 30. Okay? So what has happened? There is a demand for bonds. Demand for bonds means what? More. Because nothing has changed, let us say. This is constant. This goes to 30%. Where will the bonds come from?
Come from the loan.
Available bonds will be outbid. There is an available pool of government bonds. As of now,
the price of bond
I call it very short term.
The price of the bond will go up.
आजकल परसों में bond issue तो नहीं है. The available stock of bonds is not going to increase. Okay? So the moment Subha announces this to 30, as a bond trader, I know that my bank requires more bonds. All the 100 odd banks require more bonds. कहाँ से मिलेगा? Till there is a fresh issue of bonds, I will outbid the bond others, which means the demand for these SLR bonds is higher than the supply because supply is constant. In this very, very short term.
There are two issues there. One is are all the bonds only with the banking sector?
No. That's why the system can survive. If all the bonds are with the banking system only, as it used to happen in olden days, because 6% or from there, nobody, because you're forced to banks used to keep it. Now, bonds are being held by LIC, I mean insurance sector,
Non-bank.
provident funds,
Non-bank.
non-banks, as well as corporates. Treasury bills are held widely by corporates and state governments because treasury bills are what are called cash management instruments. I have a cash, like SR, I think was the first one. I don't know. SR Group.
SR Group. Shriram Group.
SR shipping, SR is.
Okay.
Vodafone,
ESSR.
Vodafone is.
ESSR.
ESSR. I think so. I'm not very, I should not be very badly mistaken because in those days I never thought that this could be a good record of history. They were the first ones to buy treasury bills in huge quantity as cash management. What they did was they borrowed abroad, external commercial borrowing. And when you borrow in bulk and you utilize it as and when your projects need money. No, like let's say we are going to build a hostel here. You borrow in bulk, let's say 10 crores or 20 crores. But you don't make the payment suddenly. So what you do with this huge amount that you have, it earns nothing. So you go to what is called short-term money market instruments, and this is the best short-term money market instrument. So they bought treasury bills.
This is what China does, for instance, with buying the American treasury bills for liquidity.
It does on a global scale, literally global. That's why in my investment management, in fact, today in an examination, I've given something like this. You know, bond prices are a function of interest rate. Here, interest rates have not changed. Nothing has changed. An announcement or a fear that Subha will increase, or Reserve Bank will increase the SLR.
But actually, there is a link with interest rate. The thing is, the moment you say that the SLR is increased, what does it basically mean? It means you are cutting down the money supply, which means the rate of interest will go up.
Economist. You come into the picture when the ripples have all settled down. I am a money trader. I am in the picture only when there is a ripple. You get the point?
No, I'm just saying the thing is, the moment why are you doing it? Basically, that is the target, and that's what. And this is the functional part what is happening, and that will ensure the interest rate actually will go up.
You say mean reverting, no?
So
it should be around that level. It will come to around that level when the supply increases. You know, like I use your supply demand theory very effectively here because supply has not increased. Till supply increases, till it readjusts. You shown in your graph till it adjusts back to that level. So till then there's a huge amount of money to be made. Anyway, back to what is the time? We have to keep track of that.
One.
Okay. Now let me. Yeah. Some of the things that I told her last time which are interesting in banking. A. There is no link as of now between this and this. So we'll put some kind of an equation. So what is loans now? Total amount of loans can be this is equal to y minus whatever CRR
We call it Z or something.
into y minus SLR into y minus some data for cash. Okay? I am presuming that this we will now call it investment. In fact,
Does the other countries have this liquid asset requirement?
no, not many.
Which means only the CRR is the only way which.
This is CRR is about the only monetary instrument that they have. But what they do is they get into OMO, Fed, open market opportunity.
So that is true, but the thing is that the sheer fact that the first bit, which you said, the short, uh, that you're lending long term, you're borrowing short term, that issue of the,
that will continue.
that means it's much more serious for the other countries than India.
Yeah, that's why they fail. See, if this Northern Rock and all these people had this thing, had SLR to this extent, they would not have been a problem. I mean, the problem would have been considerably reduced. I don't know. I have not made a survey of this.
This reduces the risk basically
It reduces the risk.
to the guys who have put the money in. But the difference still remains the same.
The only problem with this, the only problem, I think I'll reduce. The only problem, sir, in this is, if this market seizes,
Since this is in the hand of the government, so unless the government seizes, it's not a very big.
not in the hands of the government. Government can't buy its own bonds. Again, RBI plays a role.
So central bank, I mean RBI, or the,
No, let's say that just like it happened in the US, people lose, there's a run on quite a few banks. RBI gives this, or they say they have this money. And technically, let's say RBI does not give more money than whatever is here. Then they start selling this. The government bonds market is liquid if it is at least as well developed as the Indian market. But it could also seize.
If,
Those are very extreme cases.
if everybody sells.
Yeah. Like the Russian bond market seized.
So then basically that having India having SLR is not very different from what Fed is trying to do. It is buying up the loans which have gone bad in the US. I mean all these subprime or everything.
That is slightly qualitatively little different. It is buying from here.
Yeah, that's the basic difference. But if you really look at, if this market can seize, and if that has seized.
No, and Fed is buying this, RBI is not. The MSS is this. That is why there is such a hue and cry about MSS. There is a long write-up about MSS. RBI is issuing bonds on behalf of Government of India. I mean, that's a very, it's supposed to be, what do you call it, an unusual event. It should not be taken as a precedent, etc., etc. But RBI, as of now, in fact, responsibility bill,
FRBM.
fiscal responsibility bill.
Budget management.
RBI is not to invest in bonds issued at except to the extent they require for OMO. RBI does not participate in auctions now.
No, that's again a standard macroeconomic debate that should the central bank be independent or should not be independent. Now again after this crisis, everybody is going back to the thing that central bank should not be.
That's why the Oriental or the Indian way of golden mean path works. You cannot have a cut and dry kind of thing. There should be some kind of flexibility.
If you look at Japan and the US, what they've done basically they've taken over the loans.
Yeah.
Effectively what the SLR we have is the same thing as.
Yeah, that is the stability that part of it. But why is it 24? This goes back to our plan period. The banks were required to give helping hand. All the 5-year plans, where would the money come from? The money has to be savings, as he said, public savings or household savings, etc. Since household savings come into this, the government wanted to direct or channel these savings into what was called productive or what it was preferred sectors, priority sectors.
Priority sector.
Yeah. So, एक तो priority sector lending हो गया. This is banks giving directly, but the government had its own plans. Where did the money come from? This was raised to very high level. So the money from here went to prior loans. Of the loans, most of it was priority sector. It had reached, I think, 45% or 50% of the loans had to be priority sector. Even now, there's 30% or something. And let's say half of the money went here, and from here it was supposed to be used for building dams and things.
This is like infrastructure sector in a way.
Yes, it's like your infrastructure.
It's the way to reduce the.
There is a technical term used in India. I don't know if I get it, I'll tell you. I have not used it for a long time. Why? Should we have SLR? It is required for liquidity. Okay.
That's one side.
Should Reserve Bank impose it? I, as a central banker, will say yes. But there are many people who say this is not.
This is a development role kind of a.
The developmental role comes beyond a certain level. Let's say beyond, say, 15 or 16 or whatever it is. This is high, and this was raised to very, I think, 50% to 48% or something.
35 was I think the highest.
No, how? It was
SLR only.
58.
No, total was yes, but only SLR was about maximum 35%.
No, sir. 25 half, but if you see old one, I
No,
think
35. I think that table is there in the handbook of statistics.
whatever.
Total was almost I think 60%, CRR plus
So
SLR.
then Reserve Bank said we are.
37.5 I think was the highest.
So then they said we are doing it differently. The Reserve Bank did a lot of things which were different. Some of them are, because of some of them we are happy now. That is the, okay. Now this is CRR, this is SLR, these are the reasons why we have now PEA and sorry. Let me do this. Let me complete the balance sheet now. So you have loans. I am not talking to you about products of loans which could be different, term loan, etc. We need this, we need this, we need this. Then the last one is, this is A, mandatory. Will they have more than SLR? Will banks want to invest in SLR bonds or government sector bonds, or we'll put this like this and we'll call them sovereign? Will banks want to invest more in sovereigns? I just answered. Yeah, I am in class. Are you okay? All fine? Okay. Will banks, see, so far there is only regulation of SLR CRR. ये तो करना ही है, इतना तो करना ही है. Will banks invest more than this in sovereign? Will banks invest in non-sovereign? What we should call it non-SLR. Will banks want? These are all fixed income.
Corporate bonds.
Yeah. Non-SLR fixed income securities. If you remove fixed income, which is A and B, you are left with equity. Stock market. Yes, they will, for the following reasons. A, quite often giving a sovereign bond as a collateral, you can raise funds in the banking system. And that is a thing called repo. Bank uses that instrument or that agreement, that way of lending and borrowing. Yeah. So for collateralized interbank borrowing and lending, you need sovereigns. Sovereigns in the sense sovereign bonds.
And moreover, the risk is, I mean, that is the sense of security is there because they are
For whom? For the borrower or the lender?
for the borrower.
Borrower?
It will be lender. Who is lending?
Yeah.
Who is lending?
If I have sovereign bonds, and I offer it to you as collateral, you will lend me money readily, and you will lend me money at a cheaper.
At a cheaper rate, because I know that
And
is
therefore,
collateral
and
security.
therefore, for cash management, we are worried about liquidity.
Liquidity risk.
So therefore, for cash management, over and above SLR, because SLR, though CRR is to be shown to the Reserve Bank or maintained on an average basis, SLR is to be maintained on a daily basis. The inspectors will go and check whether you had it. If you don't have it, you have it.
So basically that is the online system. They will just check what is the total deposit and then
Post facto monitoring.
post.
मतलब historical figures are checked. One is offsite monitoring, and then when you go for inspection, you check it. Because भाग तो नहीं जाओगे ना. You don't need to do real-time monitoring.
So that the 14 days rule again applies. The last day is flexible. Other days are
In this, every day you are doing.
80% or the 100%?
No, every day 100%. Because this does, according to the Reserve Bank, this does not require, and this is was volatile. After bond खरीदे तो रख लो. This is part of the investment.
No, but what I'm saying is the deposit is changing every day. That's why the
No,
SLR is.
monitoring is done as of one specified reporting cycle.
That is what I'm saying. So in those 14 days, you have a.
Let me explain this. This is, let us say, nth reporting Friday. Then you have n plus 1, sorry, n minus 2 reporting Friday. Then you have n minus 1 reporting Friday. Then you have n reporting Friday. Then you have n plus 1. I hope. So, these are 14 days, 14 days, 14 days, Friday, Friday, Friday. N is present, today, reporting Friday. For this period, CRR is maintained based on an daily average basis.
SLR.
Sorry, CRR. CRR is maintained on a daily average basis with certain conditions during this period, based on this.
So you have almost a month to comply.
You take the 15-day-old figure.
I mean, the supervision is done after 1 month.
Language is CRR is maintained on a daily average basis with minimum of 85% compliance on the NDTL, net demand and time liabilities of the previous reporting period.
85%.
85.
So there's a kind of there's a bit of a. I'm just looking at the way the profit opportunities are there.
You have a little bit. Flexibility has 15.
So if you are a very, very professional run bank, even that can be.
Started with 85, then they change little bit. To like to change little bit here, little bit there. So that's but there is an opportunity for not full. So flexibility is given, but not total.
So up to 85%, that means 15% of the funds, if you have additional funds on the CRR, that you can.
You can play around with that 15%, which could be huge, which is huge for state bank and things like that. So that is it. But SLR is maintained on a daily basis in this period, in this 14 days, based on the previous reporting Friday. Because by then your figures are ready and you have no business to say I don't have. And therefore the market is very active on the first reporting, first day, that is Saturday.
No, but we are at N.
We are at N.
So we don't know what is N plus 1.
No, N plus 1 is future. For the next 14 days,
yes,
I have to maintain CRR and SLR.
Okay.
Right? CRR I maintain based on these figures.
1 month back, I thought.
1 fortnight back.
14 days back.
Okay, 14 days back you have to maintain the CRR
That is
with
40%.
85%.
With 85 minimum that I have to maintain.
And so how much time I get for SLR?
28 days.
This figure you take for SLR. So I will look at this liability.
And then I say you should have the.
Then I will, let's say this liability was 100. So 24 crores I have to maintain on every day. My SLR holding should not be less than 24 crores from first day, second day, third day, fourth day, fifth day, sixth day, 14th day. And on this reporting Friday, one of the statements I will send to Reserve Bank is that my SLR holding from here to here, based on this one, is so much. That's how compliance is. Acceptable?
No, I'm just trying to understand is that N minus 2, suppose you had 100 crores of the extra deposit. And
let's make it dramatic. Your liabilities, deposits were 100 crores here.
so at that time you should have a 24 crores.
Your liabilities as on this day is 100 crores. In 14 days it became 200 crores. But this is the present. This is present. Or day today. Okay? That is today is first working day after this period. Okay? in this period of 14 days, I have to maintain SLR of 24 crores and my books should show on every day 24 crores, minimum of 24.
So which means from 100 to the today, have any additional deposits?
That doesn't matter.
I'm just saying that gives me a possibility of making money.
Yeah, yeah.
I mean, it could be the other way around.
That you can lend fully here. What you mean is that you
For
can
2
lend.
weeks you can actually,
And after that you can do it.
like you have the non-SLR or any other instrument.
This is taking into account administrative convenience. See, the call money market is vibrant, immediate, settlements are immediate, etc. But the sovereign bond market is not so
Liquid.
And I think the regulators, the Reserve Bank, etc., should not want it so, because there is volatility in the reserve.
That's another problem. The corporate bond market also is not very well developed in India. So effectively, call money is the only market where you can.
Nobody invests in the corporate market. Corporate bond market, in fact, now that you know, no, we'll have to see. The answer to that is banks don't want to invest in this because they have to provide for capital. And they have to provide for risk capital and market risk capital. Credit risk capital and market risk capital.
No, if this market was well developed, they could have an option. But now in India, they don't have the option.
No, even if there is an option, what? I can give corporate a loan or I can buy a security.
No, since it's only for 15 days, it's a short term.
वो छोड़ दीजिए, वो compliance हो गया. That is compliance. Oh, that is the actual work part of that. There is not much I would feel which makes a difference because एक दिन ऊपर गया एक दिन नीचे भी था.
Yeah, that is true, but like in the sense, if the economy is growing, then it will be more likely to go. It's more go up rather.
No, but corporate bond market per se, if you see, either I give a loan to the corporate or I buy his bonds.
Or the third option, which is
This one.
if I'm very.
That's the difference. I'll come to that. That's the Glass-Steagall line. Glass-Steagall is here.
Like
Either I buy his bond, let's say this is corporate basic. Corporate bond. Either I give the corporate money through loans, or like in the US, money comes to the corporate through issue of bonds mainly. In Germany, most of it, like India, it comes through banks. I think UK is a combination of this.
Germany and Japan, I think, are very bank oriented.
Yeah.
And
In India, you see, whatever you try to do, this was pointed out by BNB. If he buys a bond, he has to keep capital for credit risk and market risk. In this case, only credit risk. And my capital is the most expensive source of funds for me. So why should I buy bonds?
I don't understand market risk and capital risk, so I think I'll have to come that later
No,
on.
we'll do after lunch.
Yeah.
If you're free after lunch, we'll do it, otherwise
No, I'm free. I've kept it free.
yeah. So we'll do that market risk capital. We'll do capital adequacy after the break. But what I wanted to complete this portion, ये छोड़ दीजिए.
No, I'm just trying to see some of these stock market scams and these Harshad Mehta and all, where they can play. And this is what I was looking at as that windows.
If bankers were not so adventurous, we would not have an issue. Because, in fact, yesterday we were having a very big discussion. Then I told my kids that means regulation has failed. It has occurred to you just now. I think it occurred to me earlier. So why did regulation fail? In India, regulator is very, very active. He may have nuisance value. You see, the director is very particular about timing. It's a nuisance value. But then it was. He has not told me, he has not come and asked Shalini, have you come on time? How many days you have come on time? Ek do se pucho. The very fact that we used to go and sit in a bank, that was enough. Quite a few things just, like it's like a principal taking around.
No, but on the other counter side to that is a regulatory failure. Basically, is a kind of, if you see regulation as a evolving process, each failure actually improves proves
No,
the...
what I want to propose, since this is a SPM class, I can be adventurous in my discussion here, is that after lunch, I will tell you that a bank should not fail. If you have read Money Changers, banks have to make money. Banks cannot make loss. Where do they make the loss? Then the question. You have to address the question, where do they make the loss? Why? You remember I used to say that, in fact, that is what I am trying to see. With the data available, can we say that certain banks are likely to be stable and certain banks, what are the warning signals in a bank's balance sheet for banks to fail? One is the system collapses, you have a problem. That's what Paul Krugman seems to say, that the bank, the whole system is problematic, and therefore, and all the stress tests that they have done earlier was to see what are the macroeconomic variables which have moved to the bank's failure. Anyway, that will come. I want to finish something here. That is, okay. We started with take deposits, payable on demand, fine, it has its own process, and give loans. And this is what. My point is, then you tell them you keep certain SLR or they keep certain bonds, liquid assets. Fine. Will a bank have more of sovereigns than necessary? Will a bank go into what is called non-SLR bonds, say corporate bonds? There are only two reasons why they will go. A, taking the risk into account, factoring in the risk, that default risk into account, maybe this would be better. Better choice.
Even the second one, if you have a first-class corporates.
Yeah, first-class corporates. But those first-class corporates, you can use those. If you decide Tata is a good risk, now we can take a risk on Tata, exposure on Tata. I'll give here and here. The only reason why a banker would like to give here through this route than this is that this is more liquid than this. Remember liquidity risk. Don't ever forget liquidity risk. If I have Tata bonds issued by Tata Sons, I can always sell that bond today, but if I have given 1,000 crores to Tata for 1 year, or say even 90 days, I'll have to wait for 90 days. That is why Reserve Bank of India is trying to develop corporate bond market. There are two reasons for corporate bond market to develop. One is from the banking side. The other one is we have a lot of FIIs. Okay, how do you operate in a stock market? You wait for the share price to go up. You sell the share price. That is, you book your profit. That doesn't mean that you have ended the relationship with the share price, particular stock. You wait for it to come down, and then you get into it again. So, for the FIIs or for anybody trading and speculating in the stock market, there is a need for him to remove the money and get into fixed income.
Or the SLR, or they have to buy SLR. I mean, they have to buy these government bonds.
Yeah, fixed income.
One of the
corporate bonds or sovereign bonds or bank deposits. Then the money moves from debt market to stock market. If this is not available, this was what was the discussions in that Bangkok Asian bond market. If this route is not available, then what do? They take the money out of the country into a debt market which is available. That becomes forex problem.
But what about if they go into that government securities?
Yeah, good. For some reason, we have placed a cap on that, thinking that America will own government of India. There is a cap on this.
Or the foreigners can own.
FIIs cannot invest more than this in the debt market.
Even that should be, it will be corporate wise. Will not be the entire amount, or is it from the entire amount point of view also?
I think which I say interim, I'm not right. But this fear complex is there that.
So that will be true even though they will own your private corporates.
Yeah.
So we are comfortable with private corporates getting owned, but we are not comfortable with it.
Here also, I don't know, I'll have to get the number, but this market.
No, I'm just saying, the issue you said is that they have to take the money out and then they have to bring it back where the debt market is developed. If you have the SLR market itself developed, that to some extent, or maybe at some stage, I mean that should be at a later stage, SLR and non-SLR, maybe they should not be a distinction, they should be just.
That's why I asked you this working paper came before. I presume working paper is not such high level that it can be published somewhere, but it is some thought. I would like to write on this. Because you have to see from both sides, three sides, not both sides, three sides. Why will corporate issue a corporate bond market? Why will a corporate go here when this is comfortable? He will go only if this is more expensive than this. आप बोलना नहीं है, हम सब बने हैं. एक पैसा इधर बच जाएगा तो इधर आ जाऊंगा, एक पैसा इधर ज्यादा देना है तो इधर आ जाऊंगा. That is one. Why will a bank invest or any investor buy Tata bonds?
But it's credible and
Tradable, liquidity, etc., etc., etc. And from the macroeconomic point of view, from the regulator's point of view, or power that be, this is required because of the latest developments that we have. Then when you move from equity out of equity, where do you go? You see, selling share A and buying share B doesn't make much sense if all of them are correlated with Sensex. It makes sense if one is overpriced, one is underpriced. That also they do. But that doesn't. Anyway, that is a separate issue. So banks are normally not interested in this, but this has liquidity to this, and banks are slowly recognizing that it is there. That problem of capital is there.
But there's some specified corporate, not all of them.
Yeah.
Some rating has
So let's rate it. We'll have AAA, AA. That issue opens up another Pandora box. Are they reliable?
because they were rated in the US, they were all rated.
Today's newspaper is one of the
clearly
newspapers.
mentioned. I mean, they have done some rating,
No, no.
AAA and all
Oh, that is a different thing.
wrong.
Rating takes, if you start, that's why I said Pandora's box. Rating itself, we can have a discussion for 3 years.
Because the rating agency have failed in the US. Huh?
Pardon, sir?
Rating agencies, they did not do their job properly. That's why it was a reason
You
for
heard of Enron, no?
Yeah, the case of Enron.
When Enron collapsed, I'm talking of during the day, 11 or 12 or something like that, it was very obvious Enron had collapsed. Okay, the stock market had collapsed, everything. Enron had gone. But Moody's or S&P, Moody's and S&P, they were AAA rated. Because it takes time for them to correct it.
Yeah, it is mentioned here in the book, it was AAA. That is why I think, sir, they have recommended we want some domestic raters to be there.
That's different.
How do you think domestic rater will be better?
Because sir, they know the internal condition of that country. I mean, various norms and...
I can always bribe the
That
rater.
can be there, sir, you can write. But
So then-
they have suggested that we should take into account the internal agencies also, because they can play better role. Because they know the
Why
scenario
doctor
better
is
than
asking you this question is that as a FPM student, you must learn to think from different angles.
Okay.
Don't, what everybody is telling, if you are telling me the same thing, then
It doesn't...
the crisis should not have happened.
Because subsequently in one session, I am going to argue that Basel II is bullshit. I mean, I should use the word bullshit, but it is bullshit. Basel I, yes, I'll argue in the afternoon why Basel I was required and why modified Basel I was required, why Basel II is going to fail and why it should not have been done. Though I am from Reserve Bank and people better qualified and better placed are agreed for that. For your information, Basel II, USA agreed just about 6-8 months ago. About a year ago. Last time when I was speaking, they just agreed. So, I come back because I have also been an FPM student. I am still, you must learn to look at it from different angles. This is the only profession which allows you to do that. Anyway, back to this. Second, why they will invest in these. One is liquidity. Second one is if this market becomes vibrant. You know what is vibrancy? Vibrant means people are buying, people are selling.
Active, basically.
Active. Okay. You must also know what is width and what is depth. Depth of a market means a single transaction should not move the share price or any market price. That's where the depth comes in. Because there are so many transactions and the volumes are also large. numbers are large, volumes are large, that people will not associate any information in that one transaction. Width is that the number of instruments available should be large. Singapore also has elections, I'm sure, but that there is no width there. In India, you have the highest width for that. There are more than 1,000 political parties in India. Okay. Then that is that the speculative intent of the bank. Because of that, they will hold. You cannot trade it. There is a trading. There is an opportunity to speculate in sovereign, non-sovereign FI and equity. All these three are traded. Traded means what? So far we have talked of what is called spread, net interest income. Okay. There is a second type of money that can be made by banks, and that is the trading money or capital gain. You buy at a price, sell at another price. And this is huge, and therefore for trade, we don't say speculation, we call it trading.
But sir, how you are saying in non-SLR bonds, they are speculative and
Why not? Why not?
I mean, we buy at the price.
How do you find the price of the bond?
This corporate bond.
नहीं.
Why you told it?
आपने पढ़ा है how do you price bonds? Bonds price is a inverse function of interest rate.
You know the present value formula?
You know present value?
What is the present value formula?
Yes or no?
No.
You don't know present value, how do you calculate present value? NPV,
Yeah, net present value.
what is its formula? You remember that?
I'll give you now, because I want to continue with this. Cash flow in the I here divided by 1 plus y to the power of I.
1 plus y is 1 plus r.
R, y, I, whatever you want. We use y sir because y is equal to y.
Yield.
Yield, y is yield majority.
We call it r or I. You see that later. This is the price of a bond also. You can.
What is a bond? I'll give you 4 sentences. I'll teach you. A bond represents cash flows in future, or a bond represents a set of future cash flows. Okay. Now, this cash flow I will write as CFI. I is the time where the cash flow is there. In finance we say there is a time value attached to cash flows. Okay. Why we take there is a time value attached to cash flows is that an amount P will grow at the rate of R in decimals to N. This is the amount after N years. This is the amount today. This is equivalent to this. This is called the future value, and this is called the present value. This is the equation. This turns out to present value is future value of future cash flow divided by 1 plus R to the power of N. Okay? Now, since there are a series of cash flows associated with a bond, coupon bond, we say that if you sum up this, the future values of all cash flows, or rather, sorry, if you sum up the present value of all future cash flows, that will be the present value of all future cash flows. Why should I pay more than that? Why will you sell it for less than that? And that will be the price. This is bond pricing.
Now you can actually see here one more interesting thing. I think you might have already mentioned. If the rate of interest is increased, why? What will happen to the present value of the bond price? If y increases,
It will increase. If present value of bond.
I'm saying y, if y increases, is a y there?
Yeah.
What is the interest rate?
R, interest rate.
If it increases, what will happen?
Yield increases.
Let's put R. R is the rate of interest. Okay?
If it
This is R.
increases,
This you are comfortable with?
Because if R increases,
What?
yes.
This you are comfortable
Yes,
with?
sir.
This we are, from this
We
we
have taken
derive
as
this?
denominator, yes.
Okay. What he is saying is, suppose the rate of interest goes up from 9% to 10%.
Everybody wants to invest more.
See the formula?
that's not the question. Don't give general answer. Go specific to this answer. What will happen to P? If any,
R
It
goes,
Yeah.
will go down.
yes. Why will it go down?
Because it is inverse relationship between
Yes.
R is in the
and-
denominator.
Yes,
R is in the denominator. If R goes up, P goes down.
down.
If R goes down,
Then P goes up.
when does interest rate go up or down? I'll give you a situation. Reserve Bank announces repo rate cut. Do you expect interest rates to remain stable, go up, go down? These are the three possibilities. Tell me. Reserve Bank of India cuts repo rate by 1%. Do you expect interest rates to remain stable, go up or go down?
You know what is repo rate?
It will not be stable at all.
Okay.
It is a rate at which the commercial banks take money from RBI.
Okay.
That's the rate. So it will not be stable because there is a cut.
I don't want reason. I just want, do you think
Yes,
it
sir.
will not, it will
What will
go
happen?
up or down? Will R go up or down?
It will go down.
If repo rate is cut, R will go down. Okay? If R goes down,
What will happen?
bond prices go up.
It will go up.
This is,
It's a reverse
Yeah.
relationship which is going to take place.
yeah. You please take a book on, any book on investment management and read on bond prices.
Now you just go back to your Keynesian theory again. There's the first thing he discussed about bond market and money market. How the link is there. This is the formula he uses to explain how do you understand it.
Monetary economics or macro?
Keynes' general theory has this. He actually discusses the bond market very details.
Is this so?
That's how the whole money economy comes in. No? That's how he brings it.
Oh,
No, this is how, that's very,
so banya hai, sir.
no, that's actually after reading some other things, like especially that chapter in undercover economics, the PE ratio and all that, that also actually can be used from this only.
Yeah. See, the basic underlying thing is there. What she's right saying is also there. People want to invest more or not invest more, etc. But you need to know this. You need to know this. Otherwise, you will get into
This
trouble.
will be everywhere. This actually is a formula which you might have done in math in the class 8th or 9th. How do you calculate present value?
This one.
In math book you must have done this.
No, they don't.
No, I mean that one only. From that is only this is derived. And another
Yes,
thing is,
madam.
नहीं ऐसे देखिए क्लास का
Time is not.
and तो हो गया
Time हो गया, ठीक है.
145
But till I leave, they cannot go on.
so even with the equity market you can see the link. This present value also can be used for equity market also.
In fact,
But-
the basic formula or the basic way of valuing shares is this. What is a share? Why do you buy a share? Because you will get dividend. Okay? And at some point you will be able to sell it. Okay? So, if you expect dividend by the end of this year, like by the end of 6 months you expect dividend. So, dividend, D1 is there. And soon after you get the dividend, you can sell it. So, the share price after 6 months is there. What should be its present value? That's the price. In fact, I jokingly say that in finance only one formula is required. Present value. We use it everywhere, including option price.
Now, and whenever you see any interesting policy change by the Reserve Bank of India, interest rate going up and going down, now you should be able to tell what will happen to stock market next year.
Stock market, what will happen to first bond market, then stock market.
And there will be exactly opposite impact. If the stock market is going up, bond market will be going down. If the bond market is going up, stock market must be going down. So they are opposite links.
Because we say that money moves from debt to bonds, I mean stock to debt.
Because in the bond, the return is fixed,
It's
whereas in the equity return is flexible.
flexible.
So the interest rate goes up, what happens? The bond becomes less attractive. The bond interest rate is fixed, but the market interest rate has gone up. So which means if you had liquid money, you would have got extra return.
People will
That's
invest
why
more in equity.
So that basically means the bonds prices fall.
Why will they invest more?
Sir, because there is a liquidity in equity market. If the rate of interest will go up, the people will invest less in bonds and they will get attracted to the equity market.
No, I think you're
Getting
getting mixing up.
Anyway, will you-
You have to think about it a little bit. But it's not that.
If you want an advice from me, you teach. Because when you teach, you have to be very careful. It's only by teaching your ups, downs, all that. Don't worry, I've taught since 2002, so therefore up, down and all, it's part of my brain, I don't have to think about it. Even now I get confused about this up, down. This inverse relationship creates a lot of problems because even reporters have written wrongly. Bonds are bullish. What does it mean? Bonds are bullish. Stocks are bullish, yes, price is going up. But when you say bonds are bullish, are you saying that the price is going up or the yield is going up? There are two reasons why people invest in bonds. One is for yield, which is part of the net interest income here. And the second one is for capital appreciation. Their price becomes important. So in the case of bond, yield and price are different. For some yield is important, for some price is important. But for many price is important. Then this one. This is okay? Trading. You must remember the word trading. For trading requirements or greed, I call it greed. The greed of making more money. We call it other income, treasury income, etc. There are many words for it. They invest. And therefore they would also like to invest. But you go back to that famous crash and depression following the crash, then there is an act called the Glass-Steagall Act in the US. The Glass-Steagall Act was enacted where they said, if you are doing this, which is called commercial banking, you cannot do this, which is part of investment banking. So commercial banks and investment banks, there was a wall of Glass-Steagall Act, which was repealed recently, about 2-3 years ago. Not 2-3 years.
Few years, I think 8-10 years back.
8-10 years back by
I think Greenspan and
Graham. Greenspan was there, but Graham was the senator. Graham was somebody else. In India, we have never had Glass-Steagall Act kind of wall. But what happens with this is that this is a volatile, unpredictable market, and you could book a huge loss. To prevent that, for stability, there is a cap put on this. The way India has attacked or India has approached this problem is that there is a cap put on that, and that cap, I think now it is 20% of your net worth. As of now, lots of things have been tried. It has been, for a very long time, this was tied up with deposits, but you have put a cap of net worth, because if you lose that, you lose from your equity kind of thing. Net worth is capital plus reserve, so in this case it is.
so that means that bank which collapsed, that Leeson, that guy who was there.
That was the investment.
That was investment.
That's a major problem with all this news and all. No? In India, people like me, when you say bank, because there's a law, it says that only commercial banks or banks which have a license to use a bank can use the word bank or banking.
But they use, I think, all the non-bank.
In India, we don't use bank unless, except IDBI was the only exception. IDBI had bank,
Industrial Development Bank of India.
but it was not a bank, commercial bank.
How about SIDBI?
Yeah, we have bank. This is the baby of IDBI.
NABARD?
NABARD also, yeah.
I'm just thinking.
Stop thinking long back. No? When this was taught to us, IDBI was there, then I joined Reserve Bank before NABARD was formed. SIDBI was much later.
SIDBI is more recent.
Yeah, because we all felt that they shouldn't have used this word bank. Because there is a law which says it should not be used.
I guess the distinction we made was the banks and development banks. I don't know, so that's why all of these nomenclature, like both of them have development bank, industrial development bank of India.
But then unless you make this distinction, then the issue of, regulation becomes complex if you don't make this glass-steagall kind of. I'm a big votary of glass-steagall Act. Because the way Reserve Bank has sorted out this issue was that if a bank wants to do investment banking or insurance, these are the other financial business that they can do, then let them set up a subsidiary and do it. Because what happens when let's say Indian Bank or SBI sets up a subsidiary, then the total loss that you can incur is capped to the extent of your shareholding in that. Because if, let's say, if SBI caps collapses, the amount of shareholding SBI has in SBI caps is the amount they write off. That comes under this. There are 6 in this. One of them is shareholding in subsidiaries.
That also we will be linked with the capital, I guess.
No, that's not it.
That also is a possibility of.
This is called exposure to the equity market.
No, but suppose you have a subsidiary, where will that be?
There's another category.
No, but I mean, like equity, you have a 5% or 20% of your.
See, you don't trade on your subsidiary shares. No? If let's say there's a SBI.
No, what I'm saying is, you're saying that you can create an subsidiary which can do this investment.
Yeah.
So it means if I